Carol, I apologize for that introduction. I hadn't read it. That's amazing. It's a testament to the audience that they stayed awake. I would prefer if Carolyn said, I've known Rick for a long time, he's a hell of a guy. I'll listen to what he has to say. Because of all that, I'll spare you my cautionary statement. There it is. If I had it up there, it said that some of the things I say may be predictive and may come true or may not come true. It's also imperative, apparently, that I tell you as a licensed person that I act for my own account. To the extent that I have a good idea that I share with you, it's almost certain that I've already acted on it. I'm a party to numerous conflicts of interest, and I'm actively seeking more. Forewarned is forearmed. Okay? We're all clear with that. So let's get started. First of all, the first thing I'd like to do, some of you know I put on my own conference, and I've come to learn some things about conferences, and I have to tell you that putting on a day like today, with 16 speakers and all that kind of stuff, is really truly analogous to herding cats. So what I'd like to do at the very beginning of this is ask the audience in joining me for a round of applause for Peter, Carol, and all the people that helped us. A seasoned speaker always guarantees one applause line through his talk, and I just got mine. I want to talk about where we go from here. I think it's been an interesting year. It's been particularly an interesting year in the context of what we talked about. How many people were here at this sort of gathering last year? It's been really, truly an amazing, and from my point of view, a very good year. It's been the kind of year that my grandmother would have described as not too hot, not too cold, just right. The commodity prices behaved reasonably well, not spectacularly well. And the equity markets, I think, behaved in really good fashion, meaning that the good companies did well and the poor companies starved. But that's a wonderful thing in the sense that if you picked wisely, you got rewarded, and the people who were the overt scamsters either went away or they went to crypto and marijuana. God bless. On the marijuana thing, I can't resist this. I was in Vancouver not too long ago, and some people asked me about the marijuana business. And I remarked that I was delighted to see the Vancouver financial establishment focusing on a business that they had vast experience with, and conducted due diligence on nightly at every street corner downtown. I'm not familiar with Toronto like I am Vancouver, but it was certainly an interesting thing. I want to talk this year about what I see as changing in the business. And I have to say, for the first time in many years, I see the business changing for the better. I sort of hoped that I would live long enough to see that happen. Some of you know, 2 weeks ago I turned 65. I was hoping I wouldn't have had to wait and live long. But I do see things changing, and I do see things changing for the better. Many of you in the audience won't remember the 1970s. I remember them well. They were sort of a coming of age period for me. And I've told you the story several times about starting my life in financial services in the 1970s in natural resources and making an awful lot of money quickly as a young man. And I made that mistake that young men often do. I confused a bull market with brains. I thought the fact that I was in a market where gold went from $35 to $850 and my stocks did okay is evidence that I was a superior human being. Of course, then 1982 and 1983 came around, and I found out just exactly how smart I was, which is to say not very. But the reason I want to go back and take you back there isn't so much to make fun of myself, as to say that the expectations, the valuation expectations, in fact, the paradigms around natural resource investing in the financial services community were all formed in the 1970s, which is a very, very, very bad thing. Wall Street, Bay Street, financial people around the world looked to resources, in some cases dreamed of resources, in the context of oil going from $3 to $30, or silver going from $1.50 to $50, or gold going from $35 to $850. And the consequence of that is that we all looked as equity investors to companies as proxies, as commodity leverage on steroids. What we have asked companies to exhibit for 40 years is leverage to the commodity price. And that's ironic, because the most marginal companies, the companies with the highest operating costs, enjoy the best margin expansion during times when prices rise. So think about this. Most of you are blameless because most of you aren't in the financial services industry. But think about the sins I personally have committed, just in the marketplace, over the last 40 years, which is to say basically that we've asked the issuers to exhibit leverage to the commodity price. In other words, we've asked them to be marginal. In other words, we've asked them to be lousy businesses. Now, if you think about it, that isn't a very high bar to meet. It isn't a very extravagant challenge. And in fact, I have to say, despite my criticisms of the industry did what I asked them to do in spades. They became incredibly marginal. The truth is, if you look at the mining business over 40 years, all size companies, all commodities included, all jurisdictions, I suspect it's consumed, not generated capital. In other words, the business has managed to generate a cumulative loss over 40 years, which is a real special accomplishment. And they did it because we asked them to. Now, a good speaker makes you sick before he makes you well, so I'm going to make you a little bit sicker, and then you can like the rest of it. The junior industry, of course, has been the most efficient, the most marginal, the greatest destroyer of capital. If you merged every junior exploration company in the world, we talked about this last year, into one company, the Aussies, the AIM-listed companies, the Americans, the Brits, the issuers here are gagging now. Merged them all into one company called a Junior Explorco. In a very good year, this business, expenditures over sales, like mergers, acquisitions, this kind of stuff. In a very good year, that business would lose $2 billion. In a bad year, $6 or $7 billion. So let's think about what's the industry worth. Is it worth 5 times losses? 8 times losses? If the gold price went up, maybe it could be worth 15 times losses. I mean, in private equity, what price-loss ratio do you use? You get my point. And that is particularly, I think, what's starting to change right now. I'll make you a little bit sicker, just a little bit sicker. Think about the fact that in the period 2000 to 2011, when the gold price went from $260 an ounce to $1,800 an ounce, free cash flow per share among the senior gold miners declined. Now that takes special skill. The selling price of your commodity is up 6-fold and your free cash flow per share declines. How did you do that? Because we asked them to be marginal. We asked them to be growth goals. We asked them to exhibit leverage to the gold price as opposed to operational efficiency. Now, having achieved what we asked them to do in spectacular fashion, we held it against them in the financial services business. And if you look at the managements of senior mining companies, in particular senior gold companies in the period post-2011, most of them, not many of them, most of them were allowed to pursue other employment opportunities. They were driven out of the business for doing, of course, what we asked them to do. And this is where it starts to get good. I've been listening to a lot of conference calls in the last 3, 4, 5 months, going to a lot of conferences, as I always do. And what's interesting to me is that the narrative that was so attractive 10 years ago, leverage to the commodity price, allocation associated with resource growth, or production growth, is gone from the discussions. It's gone from the discussions. What I'm starting to hear now is references to things that you would hear about in real businesses. Rational capital allocation, free cash flow per share, the delta between the cost of capital and return on capital employed. In other words, at least for the time being, the investment community is asking the mining business to be run as a business. And the people in the mining businesses are beginning to take them seriously and acting like they ought to be in a real business. Mining companies saying, we're perfectly comfortable if our sales for 3 years or 4 years or 5 years decline, as long as we make rational allocation decisions and as long as over time we manage not to go away. And frankly, several companies have said this. If we can't recycle the cash efficiently, we'll sell ourselves to somebody who can. Interesting set of circumstances. Not something that you would have trouble expecting out of a real business, but a real sign of change in the mining business. And that's why I feel pretty good about 2018. I feel pretty good about 2018, first of all, because the expectations of the mining industry are terrible. I mean, really, truly terrible. If you read the research reports coming out of the major brokerage industries about gold mining companies, to describe the outlook from their point of view as muted is very, very generous. And the generalist investor doesn't care about the mining industry at all. I mean, the dumb money that we used to look at in the sector, they're absent. They say the sector is too small. That's very generous. We've lost too much money. So they don't follow us at all. The people who do follow us don't like us. Now, it's surprising that I say that that's good news, but it is good news. Sectors move because the components of the sector outperform expectation. Now, it's sad to have to say this, it's amusing, but it's important. Expectations are so low that getting under the bar would be tougher than getting over the bar. The expectations, and I'm not trying to be funny, I mean it does strike me funny, but the expectations are so pathetic. The expressions of gloom coming out of BMO, if you're a contrarian, can only make you smile. At the same time that the expectations are low, the orientation is financial performance. I actually think, and when I look at the quarters that I've seen so far reported by mining companies, the quarters are pretty damn good. I mean, forget all the mumbo jumbo, the accounting stuff, the weird accounting stuff. What I like to look at is cash at beginning of period and cash at end of period. Okay, I like to see businesses that actually generate lots of cash. And I'm starting to see cash build up on these balance sheets. It's a wonderful, wonderful metric of efficiency. So in the first expectation, in the first instance, the expectation is nil. And in the second instance, I think the reality for a change in the mining business is going to be pretty good. So I hope, having made you very sick, that I'm beginning to make you well. Does this mean that happy days are here again? Well, it really depends on who you are. Because one of the problems with this business, one of the problems with all of us, is that when the performance in the business begins to pick up, our expectations and our methodologies get sloppy again. In other words, old habits, bad habits, return in spades. The truth is that money has been made in the mining business for years and years and years and years and years by a fairly small number of fairly picky investors, people who understood their investment style, and people who understood it. Most gold speculators, most mining speculators don't understand this. Money is made really on the delta between the share price and the value. Everybody that asks questions asks a question about the price. The price of a share is really easy to get hold of, but it's a valueless number. If the price of something goes from $1 to $2, interestingly, people think that's really great. If nothing has changed with the company, it means it's precisely half as attractive. But people don't seem to get that. Conversely, if the company goes from $2 to $1 and nothing has changed, people think that's terrible. What it really is a sale. What part of a sale is bad? But what we all have to remember is that money's made in the delta between price and value. So for the price information to be of any value to you at all, you have to have some expectation of what the company is actually worth. And I think that's where the real opportunity is going to come. I think that, as an example, the major gold companies at $1,300 are fairly priced. And they're almost never fairly priced. One wonders if there is a fair price for businesses destroyed as much capital as the gold mining business, but that's an entirely different question. The truth is, as I say, that the expectations are very low and the performance is going to be pretty good. And this performance will, as it always does, carry on farther down the value chain. But I think it's going to carry on farther down the value chain in a more dramatic fashion in the next 2 or 3 years than it has in the past. In the first instance, that's going to occur because of a 15-year history of misinvestment and malinvestment. We invested a lot of money in the beginning of the last decade because capital was cheap, but I don't think that anybody would argue that it was invested well. And particularly in the exploration business, at every level, but particularly in the junior business, too much money was spent exploring for a circumstance that would cause a stock to go from 25 cents to 65 cents, rather than exploring for something that represented a genuine discovery. How many times in the Canadian dealer network did you see some amalgam of butchers and bakers and candlestick makers auction a property that had failed in the last 3 cycles, and then twin the one hole that ever worked in the last 35 years? This is not the stuff of discovery. This is the stuff of stock promotion. The consequence of that is that at every part of the business, we're critically short of pipeline. We're critically short of good deposits. And what that means is, in circumstances, as an example like Hot Maden or Reservoir, high-quality discoveries get sold very quickly at eye-popping prices, which will continue. And my suspicion is, mercifully for the first time in 40 years, that the M&A cycle that we see in the next two or three years will be disciplined and efficient, meaning that rational capital allocation decisions are going to be made. I think you're going to see circumstances like the circumstances you saw in the 1990s, where the acquisition is good for the shareholder of the acquired company and also good for the shareholders of the acquirer. I remember back, and some of you will, well, Mickey will remember certainly, in the 1990s when Francisco Gold was taken over by Glamis. This is an example of an accretive acquisition. The knock on Francisco was they didn't have the money to build up the deposits. The knock on Glamis was that they didn't have any way to grow. Glamis acquired Francisco, it answered the Francisco question, it answered the Glamis question. Francisco got acquired at a 50% premium, and on the victory lap, when Glamis went around explaining why they did it, the Glamis share doubled too. And I think you're going to see some of those circumstances in the next 2 or 3 years, which will really, I think, impact people. How are we going to make money? Well, a whole bunch of ways. I think the first way you could make money is buy some of the best and just relax. I certainly remember back in 2000 here at this conference being asked, not surprisingly, for stock picks. And I remember being able to say in 2000, you know, I can give you a whole bunch of small stocks that are going to do okay, but I think the BHP and RTZ are going to triple too. And maybe what you ought to do is buy the best of the best and relax. And I think we're probably in the part of the cycle where that's a good strategy for people. I don't think anybody will follow it, because it's not why you come to PDAC. But I think it's a very good strategy. I think for really making money, at least for really making money the way I make money, you have to be contrarian. And you have to take a series of measured risks. So although what I'm talking to you about is the fact that the gold sector is going to do well, and I'm certainly going to play gold equities, this year I'm going to begin to allocate capital to the extent I have the opportunity to phosphates, potash, which the market hates if they talk about it all the time, in disparaging terms, which is a different way of saying I'll have no competition. These are businesses where the selling price of the commodity is substantially above the industry average cost of production, meaning that the industry has a negative 20% operating margin, being miners tries to make it up on volume. But it's also a business that speaks to the fact that there's 7 billion of us and all of us want to eat. And at some point in time, if the price of those commodities doesn't return to the cost of production, there won't be any, which means there won't be any grain. My suspicion is that there will be grain and the price is going to go up. I'm also attracted to the uranium business for the same reason. IEA says on a global basis it costs us $60 a pound to make the stuff. We sell it for, what, 25? So we're losing $35 a pound, and of course trying to make it up on volume. But when you look further out, even if you don't like uranium, I live in the People's Republic of California, you know. Uranium's a horrible thing. But the truth is that whether you like it or not, in the United States it's 15% of baseload power. The equation goes like this. Either the price of uranium goes up or the lights go out. What do you reckon is going to happen? I reckon the price of uranium is going to go up. So I'm looking further out. The other thing I've learned is that if it's an idea that's really, really, really popular, it's an idea that's probably over. And so you have to see, I think, or at least I have to see as a speculator, I have to see why people don't like something and why they might be wrong. One of the great truisms in my life has been that most speculators will take technical risks. That is, they'll take a chance at a very low probability that a deposit will turn out to be success. But they won't take any perceived political risk at all. In my own life, First of all, the worst political risk I ever suffered, and this is a true story in dollar terms, occurred in the People's Republic of California. Again, it teaches me in terms of political risk, the most dangerous politician is the one that's closest. Money stolen from me by white people in English, according to the rule of law, is just as gone as money that's stolen from me by more traditional means in places that I don't know well. So I'm really, really, really willing to take political risk. That includes places like Congo, where there's likely to be a war. I mean, I sound heartless, but the truth is that the copper doesn't care how stupid the people on top of it are. Russia, places like that. You may or may not be willing to do that, but a lot of my success has come from looking for tier 1 projects. We're partners in the Great Tin Project in Eastern Congo, in one of those horrible places on the planet, but 10 times the average worldwide grade. So I would ask you to think about that. And finally, although I could talk to you about majors all the time, I know you didn't come here to talk about majors, the most important natural resource by a country mile, the one that's more important than all the rest of them put together in the small companies, is people. People. These deposits are made by people. I mean, last year my speech was about the 7-footers, the serially successful entrepreneurs in the space. That's more important than any other single thing. You have to have people that have been successful, and you have to have people who have been successful in almost precisely the same endeavor that they're starting off in again. If somebody says to you, I have been a success, and that success means that they operated a gold mine in Archean terrain in French-speaking Quebec, and what they're proposing to do is look for, as opposed to produce, copper gold in young rocks in Spanish-speaking Peru, although they may have been a success, the resume is so disparate from the task at hand that you might say that the person is unprepared for the job. So it's very important that you align yourself with people who are successful, but not merely successful, successful at the task at hand. My own belief, as a consequence of studying Pareto, is that performance dispersal curves, a sort of 80-20 rule, conform to 2 standard deviations, which is to say that about 8/10 of 1% of the population base generates about 40% of the utility in any particular endeavor, which is to say that 8/10 of 1% of the population of promoters generates about 40% of the positive utility. So if you think about the importance of people rather than the importance of politics or the importance of commodity or anything else, people are absolutely the most important. Ladies and gentlemen, I hope all of this is of use to you. I have 3 seconds left, but the truth is that I'm the last speaker, and I was also the sponsor, so I'm going to ignore that. Short of Carolyn, who had to read a 5-minute introduction, pulling me off. If there are any questions, I'd be happy to entertain. If not, thank you. Sir.
How much of the issues with the gold miners a decade ago was like the .com effect, where people, my wife was working at Nortel, and suddenly the money was there for everything. Blue Rodeo did a concert after. It just, the money went out. They couldn't hang on to any of it. How much of that happened in gold?
The gentleman asks, I think, how much of the malfeasance in the industry was a consequence of the availability of money. And I would say probably by extension, everybody here is over 21, our tendency to believe our own bullshit or drink our own Kool-Aid. I think a lot of it had to do with, I mean, I certainly remember myself as a young man in the 70s. I made a lot of money at a point in time when my peers in financial services who were involved in the Dow were getting murdered every day, and I was making money. I assumed I was smart. It turned out to be a wholly erroneous assumption. But could that have happened on a grand scale, groupthink in the mining business? You bet. And you know, money that's easy to get is tough to keep. So I think both are true. Other question? Yes?
Are you investing in Venezuela now?
The gentleman asked, am I investing in Venezuela now? If I had the opportunity, the answer would be yes.
So the answer is no.
The answer is no. I have not had the opportunity. But I'm invested in lots of other lousy countries. Sorry, yes,
You made
Mickey.
a brief reference to copper.
Uh-huh.
Give me some ideas. I'm pretty bullish on copper. Would you agree?
Mickey said he's bullish on copper. Would I agree? You know, the unspoken truth in the mining business is we raise money on gold, we make money on copper. It's a much better business. You know, last year I went for my third time to visit Robert Friedland's operations, or soon-to-be operations in Katanga. And the truth is, if you go see Ivanhoe, this is not a buy recommendation, by the way. If you go see Ivanhoe, it wrecks you for everything else. 1 billion tons of 5.5% copper. I love the copper business. It's really difficult in terms of talking about a stock if you have a sense of humor for political risk to get past Ivanhoe. I've seen a couple of projects in Chile that I really, really, really liked. And I got really excited about where they were, and I got really excited about the infrastructure, and I got really excited about 0.5. And then I kind of thought, really? I mean, let's just say we're partners in a tin project in North Kivu. And if you see it, it's 10 times the average mine grade in the world. And you see the rock, and then you see what mortals have. And you kind of, why bother? Gentleman in a vest further along. Ah, yes, sir. There's a gentleman, he's in a vest. Yes, sir.
I was going to ask you about Ivanhoe. To what extent does your assessment of the attractiveness of an investment, potential investment like that, be influenced by political events that create a fairly dramatic drop in the price, although the resource has actually apparently improved over the time?
The gentleman asked me about Ivanhoe, and I would remind you that I said if you're going to speculate, you think you can make a lot of money, you have to understand other people's objection to it. The objection to Ivanhoe is fairly easy to figure out. They're in one lousy country and in one deplorable country. I have been on record asking my clients to sell enough stock to take their capital out of it, sort of de-risk it the old-fashioned way. I've not followed that advice. Disclosure of conflict, this is a lousy visual, but it's coming out of every orifice. Lots and lots and lots of Ivanhoe. I think they're 3 of the best deposits in the world, wrapped up in one company, with the best promoter that I ever met in my life. One of them was partnered with the government of Japan, the other de facto the government of China. Not bad partners. What could go wrong? God, we don't have enough time.
Does your time horizon shift with the political winds?
Time horizon is a really good question. One of the ways that I've made money over time is preferring to ask questions where the answer begins with when, not if. Now that I'm 65, I've been through 11 5-year cycles, and they seem, oddly, as I have less time on Earth, I have more patience. It's sort of weird that way. Could Ivanhoe take 5 years? Yeah, absolutely. Does that bother me? I mean, many people have trauma holding stock over a long weekend. And I think that suggests that they don't have very much faith in their holding. Political risk. I went through Congo in 1996 when it was really rough. I remember buying Tanki mining at 19 cents a share when it had 30 cents a share cash in it. And Tanki Fungurubi. Now, bad things were happening on top. You know, I mean, a civil war, AIDS, Ebola, malaria, it was a horrific place. But as I said at the outset, and this makes me sound heartless, I guess, but the copper is kind of ambivalent to how stupid the people standing on top of it is. And if you have the ability to outlast, and I wasn't there, so nobody was shooting me, I definitely had the ability to outlast the combatants there because they were killing each other. You have to master your own emotions, I think. And if you play that game, you have to play it with money that you're willing to lose a lot of. Could there be a circumstance that could see Ivanhoe be a $20 billion company? Yeah. The last one he did went to $17 billion. So if it's a $2 billion company and you juxtapose, could it go down to $1 billion? Yeah. And could it go to $20 billion? Yeah. That's the interesting juxtaposition of risk to reward. If you can financially and psychologically stand A, the 50% loss, and B, being terrified every time you watch nightly news. I spent 40 years being terrified. So. Yep. One more, I think. Otherwise, Peter's going to be... I've worn you out. I have. I'm very sorry. Yes, sir.
Yeah, sorry. Do you expect a lot of mergers and acquisitions in the mining industry?
The gentleman asked, do I expect a lot of mergers and acquisitions? Yes, I do. And I think for the next 2 or 3 years, they're going to be mostly be smart, which will be very different than the last 40 years. I expect a lot of M&A, and I expect it to be mostly strategic and smart, until the bad habits return. Ladies and gentlemen, thank you very much. I think Peter has some words for you.